At 1:45 in the morning, the lights at Lehman Brothers were still on. This was not a normal working night. It was the end of 158 years of history. Phones ringing without stop, lawyers moving between conference rooms, executives who had spent decades inside that firm, silent, staring at screens that no longer offered answers. Outside, Manhattan at rest. Inside, the system was breaking. By dawn, Wall Street already knew. No announcement was needed. You could see it in the spreads. Liquidity had vanished overnight. Counterparties refused to trade. Overnight funding lines cut. No one trusted anyone. At 6 in the morning, Lehman Brothers employees arrived carrying boxes. Not because anyone told them to, because they knew. At 7 in the morning, the firm made it official. Lehman Brothers filed for bankruptcy under Chapter 11. Approximately $600 billion in assets. The largest corporate bankruptcy in United States history. And the moment the global credit system froze. The fallout was immediate. Money market funds broke the buck. Interbank rates spiked. Short-term funding markets frozen. Within hours, institutions around the world were scrambling to calculate their exposure. Derivatives, repos, cross-obligations. No one knew who owed what to whom. And that uncertainty was lethal. Because modern finance runs on trust, and trust had just disappeared. The origins, but this didn't start in 2008. It started more than a century earlier. Lehman Brothers was founded in 1844, a small dry goods store in Montgomery, Alabama. Three brothers who discovered that the real business wasn't selling cotton, it was financing it. They pivoted, became intermediaries, then bankers. The firm survived the Civil War, the Panic of 1907, the Great Depression, 158 years of history, 158 years of crises overcome. By the end of the 20th century, Lehman was a modern investment bank, trading, structuring, distributing risk at global scale. And its culture reflected that evolution. Aggressive, relentless, performance above everything else. The firm didn't compete. It hunted. And in the early 2000s, it found its most profitable prey, the U.S. mortgage market. Cheap credit, low rates, public policies designed to expand homeownership, a flood of mortgages. But Lehman wasn't a traditional bank. It was something more powerful. It was a securitizer. Banks originated mortgages. Lehman bought them, bundled them, sliced them into tranches, and sold them to investors around the world as mortgage-backed securities. In theory, diversification reduced risk. In practice, it concentrated it. Because the quality of those loans started to deteriorate. Fast. Subprime mortgages. Adjustable rates. Minimal documentation. Products designed not to be repaid over time, but to generate immediate volume. And rating agencies were stamping AAA on the senior tranches of those instruments. AAA, the highest possible rating. Equivalent, in theory, to U.S. Treasury risk. Investors believed it. They weren't losing money. They were hiding it. The trap Lehman wasn't just packaging and selling these assets. It was holding them on its own balance sheet. And to amplify returns, it used leverage. Leverage is simple. Borrow to invest more. If you have $10 of your own and borrow 90, you control 100 in assets. If those assets rise 1%, you earn 10% on your capital. But if they fall 1%, you lose 10%. Lehman took this to the extreme. At its peak, it was leveraged more than 30 to 1. That means a drop of just 3% in the value of its assets could wipe out its capital entirely. And those assets were not stable. They were tied to a real estate market that was already starting to crack. One of the ways Lehman disguised that risk was through an operation known as Repo 105. A standard repo is a short-term loan. Economically, it is debt. But Lehman structured certain transactions as if they were real sales that allowed it to temporarily remove tens of billions of dollars in assets from its balance sheet at the end of each quarter. On paper, leverage looked lower. Debt looked smaller. Financial health looked stronger. Days later, the assets came back. The risk never left. It was accounting, not economics. By 2007, the cracks were visible. Home prices stalled. Delinquencies began to rise. Subprime lenders started failing. Other institutions reduced exposure. Lehman did the opposite. It increased its real estate positions. expanded into commercial property, accumulated assets that were increasingly hard to sell. Because when liquidity disappears in a leveraged system, everything becomes unstable. Assets that can't be sold must be written down. Write-downs destroy capital, which forces more selling, which pushes prices down further. A cycle, a spiral. The system had started devouring itself. The weekend by September 2008, the situation was critical. Lehman needed a buyer. Fast. The negotiations happened in a single weekend. September 12th to 14th. Two serious candidates, Barclays, Bank of America. The goal, a private solution. Avoid the collapse. Avoid using public money. Avoid systemic panic. But there was a problem. No buyer was willing to absorb Lehman's liabilities without a government guarantee. And the U.S. government said no, because months earlier it had backed the rescue of Bear Stearns. And the political tolerance for another bailout had run out. So the line was drawn. No backstop, no guarantee, no deal. Barclays walked away. Bank of America chose to buy Merrill Lynch. Lehman was alone. And in a system built on trust, isolation is lethal. The decision not to rescue Lehman is one of the most consequential in modern financial history. It sent a clear message. Large institutions could fail. Counterparty risk was real. No one was necessarily safe. And that message spread instantly. Because if Lehman could fall, anyone could. Liquidity is oxygen, and Lehman had run out of air. The bankruptcy triggered immediate contagion. Because Lehman was not an isolated entity. It was a node in a dense network of financial contracts, derivatives, repos, swaps, cross-exposures connecting it to institutions around the world. When it failed, those contracts had to be unwound. But no one knew the net exposures. No one knew the risk of the counterparties of their counterparties. So everyone pulled back. Credit stopped flowing. Companies couldn't finance operations. Consumers couldn't access loans. Markets collapsed. Global trade contracted. And governments had to intervene at an unprecedented scale. The narrative that followed tried to frame Lehman's fall as an accident, an isolated shock, the failure of a single firm. It wasn't. The reality was structural, predictable, because every incentive in the system pushed toward more risk. Mortgage originators had no incentive to ensure long-term solvency. They sold the loans immediately. Investment banks earned fees by issuing. Maximum volume, maximum fee. Rating agencies were paid by the same issuers they rated. Investors chased yield without fully understanding the assets. And leverage amplified everything. Every participant optimized for individual gain. Together, they built a globally fragile structure, dependent on rising prices and constant liquidity. When either of those two conditions reversed, the system was exposed. When both reversed at the same time, collapse was inevitable. By the time Lehman fell, the warning signs had been visible for years. Rising delinquencies, deteriorating credit standards, structured products few people fully understood. But the profits were too large, the inertia too strong, the faith in stability too deep. So the risk was ignored, postponed, repackaged, until it could no longer be hidden. The collapse of Lehman Brothers was not a historical accident. It was the manifestation of accumulated systemic risk. And that risk does not disappear. It transforms. It shifts. But it remains. Because it is embedded in the architecture itself of modern markets. Interconnected. Leveraged, dependent on trust. The next crisis won't carry the same name or the same shape, but the same engines will be there. Leverage, opacity, trust, because they are structural, not temporary. That morning in September 2008, as employees walked out with boxes from an institution that had survived wars, depressions, and more than a century of history, the focus was on a single company, a single bankruptcy, a single event. But what really collapsed was something larger, a set of assumptions about stability, about risk, about how the financial system was supposed to work. And those assumptions were wrong. The system did not fail. It revealed what it always was. Subscribe for more.